This is the first part of kind of a two-parter on the adjustment process. We are learning in this book accrual accounting. And accrual accounting, revenues are recorded when they're earned and not necessarily when the cash changes hands. We defined expenses as costs used to earn revenue. So in accrual accounting, expenses are recorded in the period they are consumed or used up to earn revenues. This is in contrast to the cash basis of accounting, where the only time we would record anything is if the cash changes hands. Two basic concepts that are part of generally accepted accounting principles that help explain why we use accrual accounting and why the adjustment process is part of the accounting cycle. The first one is the accounting period concept, and it requires accounting data to be recorded and summarized for a period of time. And the other is the matching concept. We want to report the revenues earned for the period in which the expenses are occurred in generating the revenue. And so for this reason, when we take a deposit, a business, for services to be provided in the future, before we've provided the service or delivered the product, we have in essence collected deferred revenue. Let's say if we take a deposit, what really happens on our books? Well, our cash increases, so we have to record it, right? So we're going to record cash is coming in. And the offset to that is going to be to the account unearned fees. Unearned fees is a liability account because we haven't earned it yet. If we don't ever provide the service, we have to, we would return the money to the customer. Because we owe our customer when we've collected money in advance. So again, here's another, this is a new account, unearned fees. Another thing that's different about this is one liability account that does not end in the word payable. Now on the other side, if we pay an expense in account before we have used the service or consumed the product, we have what's called a deferred expense. And deferred expenses are classified as assets until we use them up. They're an asset because if we don't use them, we might return them and get a refund. And we're trying to match it to the period that it belongs to, the accounting period. One very common expense that businesses pay for in advance is insurance. They might pay it for 6 years in advance. They might pay an annual premium. Usually a policy is at least 6 months. When we pay insurance in advance, well, we're decreasing our cash, aren't we? But we're increasing this account called prepaid, whatever it might be. In this case, prepaid insurance. Prepaid insurance, again, is an asset. Okay, so we're going to get into the actual adjustment process. I was just trying to give you some background on things that cause us to have to look at our books